Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today, we're going to take a look at some commodities, cannabis, as well as oil and gold and silver. So the collapse of oil prices was inevitable. So we're going to look at how that's going to force a widespread stock liquidation and how debt-stricken countries like Lebanon are legalizing cannabis growth. And in the recent COVID chaos, what that means to other central banks. We're also going to highlight the anatomy of a fiat currency collapse and what that means for gold and silver. Starting with Lebanon becoming the first Arab country to legalize cannabis growth, looks like the Lebanese parliament approved a law last week that allowed its growth for medicinal and industrial use. Unfortunately, the legislation does not allow for recreational use of cannabis amongst its citizens, which is unfortunate. If regulated properly, it could be a net positive for Lebanon. They have one of the best hash markets in the world. So when I was in Amsterdam, I wanted to try Lebanese hash and try to compare that to Moroccan hash. And I like both of them. They're different, but both really, really good. This is quite the turn for Lebanon. In the 90s, they spent millions of dollars fighting cannabis farming. And now they're looking at the opportunity to bring in $1 billion a year in revenue for the Lebanese government, according to a McKinsey report. Brazil is also looking to issue its first authorization for manufacturing of a cannabis-based product, and Scotland is getting its first legal cannabis farm. So we're already looking at cannabis becoming a global commodity, with people looking at it as a potential savior for revenues and budget deficits. A lot of countries are going to have to look outside their traditional revenue sources and get creative, because this global pandemic, this complete global economic collapse is not normal. So the price of oil and that crash was inevitable. So we can see that the composite indexes was coupled with the price of crude. And so this chart combines interest rates and inflation and GDP into one composite indicator to provide a more evident comparison to oil prices. So it shouldn't be surprising to see sharp declines in oil prices with downturns in economic activity, a drop in inflation, subsequent declines in interest rates. You can see from this graph, with oil prices resuming a long-term downtrend, you can see kind of these Fibonacci triangles that show a short squeeze or a potential drop in the market. Anytime that you've got this triangle, it's going to be a breakout one way or the other. But you should know that just several years ago, with the Rockefellers getting out of oil, that this was inevitable to have a price decline and or full-on lawsuits for environmental damage. Either way, it was obvious to some of us that this was going to be inevitable. So the industry's inability to stop drilling and creating an oversupply of oil had a surge in direct result with the innovation of extraction techniques, or fracking, combined with the surge in liquidity provided by the Federal Reserve. So this chart is showing the relationship between oil prices and the increase of the Federal Reserve's balance sheet. That induction of liquidity into the financial system by the Federal Reserve translated into an effective land rush for fracking companies. So looking at the supply price imbalance, the current levels of supply create longer term issues for prices globally. Compounding the problem is a weaker global demand, as well as a lack of storage. They're not able to find really any storage capacity. So in 2008, prices crashed. The quantity of oil available in the market hit an all-time low, while the global demand was at an all-time high. So that fear of that peak oil, it was rampant in the news headlines with financial markets. And then that financial crisis quickly realigned prices with demand. So the supply-demand imbalance combined with suppressed commodity prices in 2008 was the perfect cocktail for a surge in prices as the fracking miracle came into focus. And now with stay-at-home decrees, you can see the demand side of the equation just plummeting. And like I mentioned, there's nowhere to store this oil. So according to the IEA, their warning of storage could become unavailable as early as June. We just saw job losses rise to 22 million on the unemployment. You're going to see incomes decline, and then you're going to look at how that's going to impact the overall economy as consumer spending decreases. So who cares? What does this even mean? It could mean that in 2020, you have oil exporter incomes plunging by over $1 trillion, and that might force a widespread stock liquidation. Oil as a commodity has a downward effect on the economy. So by itself, the decline in oil prices is generating a big shift in the flows and incomes across the world. And we can see that from record losses for the Swiss National Bank. So as I mentioned before, a lot of the central banks will print money and then just buy assets like securities on the New York Stock Exchange, NASDAQ, S&P. And so we can see the first quarter of 2020, the hedge fund, also known as the Swiss National Bank, suffered its worst quarterly loss in over a century. And so they had a record loss of 38.2 billion Swiss francs, and said that it was because of the outbreak that was impacting the financial markets. So Reuters said that this loss is the largest decline in their history, dating back to when it was founded in 1907. So, as we said on this podcast before, the central bank owns a record amount of US stocks, including Facebook, Amazon, Netflix, and Google, about 800 billion francs or 820 billion US dollars. The problem is when these central banks sell, who's going to be the buyer in the billions of dollar marks? It's not going to be the mom and pops. So when countries sell, there aren't enough buyers on the other end to make up that difference. So this is going to be maybe a game changer in the way that we allow securities to be purchased. So some people are pretty antsy right now, and they're asking if the bear market is over already. And sad to say that no, a bear market has three stages. So there's a sharp downturn, there's a reflexive rebound, and then a drawn out fundamental downtrend. So bear markets start off with three stages. The first one is that they often start with a sharp and swift decline that we've already seen, and we've also seen a 50% retracement. So number two is after the decline, there's an oversold bounce or that retracement. And then what we haven't seen yet is number three, that long-term decline that's going to continue on. You probably see some W recoveries, which is just volatility going up and down, L-shaped recovery for other sectors. And then for cannabis stocks, we expect that V-shape recovery eventually. The Dow theory also suggests that the bear market consists of three down legs with reflective rebounds in between. So I definitely think we'll see a lot more volatility than in previous recessions. So in the short term, it looks like it might be overbought. And we can see from that Fibonacci triangle that on a short basis terms, we can see that it has been overbought. You're going to get that rebound, but be cautious because we can drop another 50%. We had some banks report some earnings last week, and so the first quarter analysis, looking at a decline levels for first quarter at about 2.3%, with numbers that are now revised for a decline of 4.4% in the first quarter and a total decline of 10% in the second quarter. And with the entire U.S. shutting down, you're looking at about 20% unemployment, negative 20% GDP, but they're only saying that earnings are expected to decline by 10%. That doesn't sound right. In fact, you just need to look at the ratio of the Russell 2000 and the S&P 500. That's a ratio for small cap and large cap. And then when looking at averages, we can see the advanced decline in the number of stocks trading below the 50 and 200-day moving averages. So it looks like the bear market's still intact with about 21% down from its February highs. So if the market does drop 20 to 50%, whatever it is, we may see an all-out fiat currency collapse, otherwise known as helicopter money. That's the infinite money printing to destroy all fiat currencies. So the first phase of the deterioration of any fiat currency is going to be deflation. This is because the more any government prints, or not government, I should say central bankers, the more that any central banker prints, you're losing money. So you can see from this graph, it's gone parabolic with fiat money printing. And so that's going to deteriorate any fiat currency. You can see going back to 1600 with the introduction of fiat currency in China, that it always reverts to its intrinsic value of zero. So with the massive amount of overprinting and the destruction of the US dollar, the way to protect yourself is with money. And so precious metals have always been a form of value for money. And so I would pick up as much as you can. Silver to gold ratio is really, really good. Probably the best it's been in 5,000 years. So silver is incredibly inexpensive by comparison. So you might want to look at that. But before we get into silver, let's check out gold being an investment that some pundits are calling a no-brainer investment. So Peter Schiff has mentioned Bank of America, its 18-month gold target of 3,000 per ounce, which is incredibly rare for a bank to promote its competitor. So Peter Schiff is even saying, this is Bank of America. This isn't Peter Schiff. This isn't some crazed gold bug. This is Bank of America. So I mean, it's a big deal when Deutsche Bank and Bank of America are talking about gold in a positive light, not saying it's some relic that comes out of the ground and goes right back into a safe in the ground and has no store of value. They're not saying that. They're saying that its price target is going to be double in 18 months than it is right now. That's crazy because they have everything to lose by saying that, because the dollar printed by these central banks are really just backed by the full faith and credit of the government. And so if there is no faith and credit as debt, why would they promote gold? So Peter Schiff called gold a no-brainer investment, but silver is also worth paying attention to. The Silver Institute released a World Silver Survey 2020 report featuring a detailed overview of last year's silver market. Investor demand was the biggest driver in the silver market. Global silver investment jumped 12% to 186 million ounces, representing the largest annual growth since 2015. The price of silver rose to a 3-year high at 19.65 last September. Now, remember, that's the spot price. So the physical price, if you tried to actually go out and buy one, is going to be anywhere from $23 to $30 for a 1-ounce coin. So the spot price being somewhere between $15 and $17 right now, in actuality, is really anywhere from 25 to 30 bucks. So on the supply side, global mine production fell for the 4th consecutive year by 1.3%, and there's a lot of silver production declining as well. The coronavirus pandemic also shut down a lot of mints. The U.S. Mint, the Swiss National Mint all had to shut down operations because of COVID. So we've talked about the silver to gold ratio in the past being historically high spread. So you can see that the ratio was pushed to about 93 to 1. In other words, it took 93 ounces of silver to buy 1 ounce of gold. It's around 110 right now, or 112. So by that ratio, silver is historically the cheapest it's been and historically outperforms gold in a gold bull market. So silver should really catch up to the price of gold. One thing I want to highlight is a purchasing power of money, a store of value like gold and what it can buy. The point of buying physical precious metals isn't to then sell it to get fiat currency, because fiat currency doesn't really have any value, at least not right now. So what can it buy? So this graph is kind of interesting in the fact that it will tell you over time how many beers you can buy with an ounce of gold. So in 1971, you could buy 48 beers with an ounce, and then that spiked to 227 beers in 1980. So 1980 had a crisis, and that meant that you could buy more as the price of gold went up, and probably the price of beer went down. So we saw an average, since 1950 of about 89 beers, whereas right now we're seeing 115 beers per ounce. So you can't buy as much now as you could in 1980, which just kind of tells me that there's some room to work with. Either beer has gotten more expensive, or the price of gold isn't as high as it could be. So with a little bit more fear, with a lot less manipulation, the value could go a lot higher. We're also seeing some talks about a reset. And so when the government confiscated gold, what they did is they reset the price. And so it was $20 and it doubled basically overnight after the government forced everyone to turn in their gold as a state of emergency. And so that gold reset could happen again and jump from 1,600 to 5,000 overnight. But I would continue to see the depreciation of the dollar to zero and some kind of gold-backed currency. Times are crazy. Invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.